Well, welcome everyone to the 2025 FMD Federal Budget Review video. I'm joined today, firstly, by Cameron Sicker, Financial Advisor at FMD, who will share with us some of the measures from the budget. And we also have Mike Reynolds, Director and FMD Investment Committee member, who will share some of the implications of the budget more broadly on the financial markets. So, Cam, let's get stuck into those key budget measures. We've sort of grouped them across 5 areas, I think it's fair to say.
That's right. So, we'll start with super and pensions. There's not a whole lot to report there. The super guarantee amount is going to be going up from 11.5% to 12%. That was already legislated a long time ago. It's gradually been going up from 9.5% to where it be at 12%. That's the last one, so there won't be any future increases coming up. But the other one is the $3 million super balance tax kind of thing. There's no more announcements there. Labor is still trying to get it through the Senate. It's not likely to get through before the election, so it's kind of an election issue or a post-election issue. And then the other one is the transfer balance cap. That's going to be indexed from $1.9 million to $2 million as of the 1st of July. Again, that was already sort of baked in with all the inflation numbers that have come through. So not really a budget measure, but it's going to come into place from 1 July.
Yeah, so it seems like with the $3 million tax, Cam, that the government, despite all the feedback about the unique nature of taxing unrealised gains, they're stubbornly pushing ahead.
That's right. So Still trying to get it through the Senate, and we'll see how they go. There's a few independents that are pushing back, but it's not going to get through before the election. Whether it gets through by the 1st of July start date is a big question mark.
That's right. Yeah, great. And we'll work with clients who are impacted on that should that come to bear. Cost of living.
The next main thing, cost of living, is on everyone's minds, and Labor, with an election coming up, is trying to get everyone on favour. So electricity bill will continue. It's the same thing as it was last or this financial year at the start of the year. So you'll have $150 as a rebate towards your electricity bill, $75 in the first financial year quarter and the second, which will sort of help people. They've also said that HEX debts, anyone with a HEX debt, will be reduced by 20% flat. A one-off reduction that'll happen. So if you've got an average debt of $25,000, it means $5,000 will be wiped off. And they've also decided to increase the threshold from when you have to start paying it back. So it was $54,000, and it's going to go up to $67,000 before you have to start making those mandatory repayments through your income.
If I just circle back to the electricity bill for a moment. Now, if you've got a holiday house, that applies there too if the bill's in your name, that's right? Yep.
Exactly. Every house across the country gets one. Doesn't matter if you've got 1 or 10 or 20. Every household gets a $150 rebate.
Great, thanks. And the HEX debt will certainly help those who have been building it up but not paying it off.
That's right. And I think the HEX debt also sort of relates to this home ownership and home affordability piece, because one part of when people are trying to get a house at that sort of age is part of their income is going towards paying down the debt. And the banks have to take that into account when you're going for a home loan. So if you're paying down less debt, you've got more ability to buy a house or more, affordability and all that sort of thing. So that will help this sort of ownership piece. And as part of that, the Labor have expanded their Help to Buy program. So, they're taking an equity ownership in part of the property, 30 or 40%, depending if it's an existing home or a new build. And they've expanded the price of the property. So Victoria, it's gone from $850,000 to $950,000. Queensland, Sydney have seen bigger increases as well. So it's sort of expanding that out. The income thresholds have expanded out as well. So it's a key part of what they're trying to do there.
Correct. And there are a few changes to personal income tax that were a bit unexpected. Cam.
Yeah, they someone kept them under wraps pretty well. No leaks or anything beforehand. But they're calling it stage 4 tax cuts. So they're reducing the marginal tax rate for those lower income earners from 16% as it is today to 15% on the 1st of July 2026 to 14% on the 1st of July 2027. So it means it's a tax benefit of roughly $268 in year 1, $536 in year 2, for anyone earning $45,000 or over, which is going to be the majority of people. There's a bit of interesting bits going with that, because if you're doing super contributions, they're taxed at 15% when they go in. So there is no benefit, or actually a disbenefit if you are at the 14 cent whenever it comes through. So there's a bit more nuances with that. But also it has other implications towards the seniors and Australian seniors and pensioners tax offset, because that will mean you can earn more income before you start to get towards those thresholds. So it's a lot of implications with that sort of thing, but roughly $500 a year for everyone from year 2 onwards.
What about people on Social Security and things like that? What have been measures there announced?
Medicare thresholds are increased up again, mostly with inflation. The PBS payback, I guess, co-payment is been reduced down as well. So there's little things that they're doing to support there. They're trying to encourage practices to do bulk billing, trying to expand that out so that you've got less of a gap and all those sorts of things. So there's a few bits and pieces like that. I don't think it addresses too much the underlying issues too much, but again, it's sort of linking back to their cost of living and trying to reduce the load on households.
Cam, just finally, there was no announcement about deeming rates. Can you talk us through what that might mean?
Yeah, so that was probably a bit of a surprise, and maybe it's too much of a election issue, but they're fixed. During COVID, they reduced down the deeming rates to 2.25%, because interest rates came down a lot. Interest rates have obviously come up now, and they've still left those deeming rates frozen at that 2.25%. They haven't changed that at all. They're leaving it there at this point in time. I think we're still watching and monitoring, but if they were to increase it, it might mean that people on the age pension get less. So it is a bit of it is an issue that would come up if they were to do that. And I think with an election coming up, they don't want to get too many people offside.
No one's prepared to go there at the moment, Cam.
No, neither side have said anything about
correct.
it, neither Labor
side.
or Coalition.
That's exactly right.
Great. Thanks, Cam. So look, a number of these things still need legislation, and so you need to be in government to get your legislation done. We'll be monitoring that on behalf of our clients and keeping everyone up to date. Thanks for the update.
Thank you.
Mike, if I can move to you, I guess the purpose of today's conversation and inviting you on was to talk about the potential market impacts of the federal budget. But I think it's fair to say that there might not be too many.
Yeah, I think you're right, Lee. I think the budget has all been around the election positioning from the existing Labor governments. The Liberals have equally said not much thus far, and I think the budget reply on Thursday will be interesting to see what rabbits they pull out of the hat. But our market's up 50 or 60 points this morning, so I think what that says to me is that the budget has really been a no event in reflect to financial markets. And I think, without getting political about all these sorts of things, both sides of government are reluctant to enter into any strategic reforms, which potentially, would be a good thing if someone was brave enough to go to the election around those sorts of things. But markets basically are seeing this as a bit of a non-event, and we continue on as the path we've been down for the last few years.
So while I've got you then, let's talk more globally. What things are impacting the markets at the moment, Mike?
Well, that's a far more important issue, isn't it? I think the first thing, we've seen a little bit of volatility in investment markets over the last 5 or 6 weeks. The euphoria of the Trump inauguration, where markets had a significant bounce in December. We've seen his tariff negotiation tool brought into play. The exact motivation for those tariff announcements, I think, has a longer period to play out. We've seen quite a pullback in investment markets. I mean, so just from statistical data, our market here in Australia peaked at about 8,830 points in the middle of February. As of the close of business yesterday, we were down at 8,166, so about a 7.5% decline from peak in February to the lows we've seen in the last few weeks. Interestingly enough, if we go back before December, the low in December and where we are today is only about a 3% difference. So, you've had that period of volatility. The same applies in the States. The Dow's down about 5% from peak to trough, while the Nasdaq's down about 9% from peak to trough. So this period of volatility is not abnormal. I think if we have a look at it, one of the charts that I think you've got ready to discuss, so I think this is, it's a terrific piece of information, and it reinforces the reason why you should never jump at shadows in the process. And that's what our investment committee focuses on, is trying to remove the noise from any decision-making process. In simple terms, this is a calendar chart from 1st of January to the 31st of December over the last 31 years. And what it shows is the grey bars are where markets finished at the end of the year, and the red dots are the inter-year declines. And you can see in lots of cases that, you can have a 10% pullback in the market at one point during the year, yet markets materially end up positive for the year. So I think if you go back to fundamentals, which is really what we focus on in terms of our investment decision-making, is the US economy is in extremely good shape. American corporate balance sheets are in excellent shape. You have low historical unemployment rates. And you've had also, post-COVID, a normalisation of interest rates, which was for a lot of parts of portfolios quite a difficult period to navigate. Rising interest rates from zero when there was an emergency settings to normal interest rates was a challenge. And we're now past that, because we've seen 3 interest rate cuts in the States, 3 interest rate cuts in New Zealand, 3 interest rate cuts in England, and we've had our first interest rate cut here. So broadly speaking, we are pretty positive around the outlook for investment markets in the medium term.
Yeah.
And I think the positive thing also for investment portfolios is that you're actually getting meaningful contribution of returns from fixed interest markets, which was the challenge, post-COVID.
So before I take that slide off, it's really telling us that at this point, we're certainly not panicking about these intra-year declines, and we think that there's a good chance that the returns for the full year will be much more likely to be positive.
Yeah, I think that's right. I mean, I think that there are always reasons why markets do this, and I think, I think some macro hedge funds were probably leveraged to a momentum trade, and as that momentum unwound, they were forced to deleverage, and we had this sort of pullback in the market pretty rapidly. But the last week and a half, that seems to have stabilised, and I think irrespective of your political persuasions, and I'll disclose here that I'm not necessarily a Trump fan in any big way, but I think we've just got to see how these negotiations go over the next 6 to 12 months. I don't think anyone's in a position to sort of categorically say what the outcome will be. The most important thing is to fundamentally, go back to the fundamentals of what's gone on, and the economies around the world, and they're not in the best shape that have ever been, but they're not in a disastrous shape equally. And I think that, we've made no significant changes to investment portfolios. We've maintained our positions and asset allocations the same. And, I think in the short term, it's hold your nerve, which is exactly what we're recommending clients do.
And I may have cut you off earlier, but I think you were pointing to the fact that with the interest rates normalising, we are getting fair and perhaps better risk-adjusted returns from the bond side of the portfolios.
Yeah, look, it probably hasn't played out as much as we maybe thought it would, because it's the short end of the interest rate curve that's adjusted. I'll give you an example. So Bank of New Zealand reached a peak of 5.5%. They're now at 3.75. The US peaked at 5.5%. They're now at 4.5%. And the Bank of England peaked at 5.25, and they're now at 4.5. Now, we only peaked at 4.35, and we're now back at 4.1. So they had a lot more scope to cut interest rates at the short end. Their longer term interest rates, which is where you get your biggest bang for your buck in bond portfolios, longer term bonds have eased a little bit, but more in line to where short-term interest rates are. So you actually had an inverted yield curve in a lot of parts of the world where short interest rates were higher than longer-term interest rates. We're now sort of back with pretty flat interest rate curves. So, but our portfolio positioning for fixed interest has been pretty diversified, and relative to most benchmarks, we've had a period of outperformance for our fixed interest rate positions. So that's been pleasing, and I think that they're actually making contributions of return that we weren't getting during the COVID periods.
Yeah, absolutely. Thanks for that, Mike. So if I summarise just briefly, very little impact from the federal budget itself likely to be on the federal economy. Trump's manoeuvring around tariffs remains something that will create uncertainty and therefore volatility, but broadly, our outlook is relatively positive, and we're keeping our settings pretty steady at the moment on that basis.
Yeah, absolutely. And if things change, I mean, markets are fluid. So if there's a material change in things and either an opportunity presents itself to take advantage of the volatility, or something materially changes where we want to be a bit more defensive, that's what the investment community's role and decision-making process is. Yep. But as we see it at the moment, I think it is hold the course, and time will determine, and more clarity will be revealed as to what the final sort of settings of these negotiations are. I mean, I think at the end of the day, Trump is a deal maker. He's always been viewed as that, and the posturing around tariffs at 25% one day and 10% the next day is purely a reflection of a negotiation bargaining setting that he is trying to negotiate. And I think you can't come to a conclusion in 3 months. So we'll sit and observe, which is really what we're doing, and we'll have more a clear review towards the end of the year, maybe.
Yep. Great. Well, thank you, Mike. Thank you very much for your insights on the markets. Cam, thanks very much for the budget update. We'll keep clients informed as things go through, if legislation gets passed, and we'll certainly keep an eye on the outcome of the election and what the implications might be for all of this stuff. Absolutely. Thanks very much for joining me today.
Thanks.
Thank you.